This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Dan O'Brien, K-State grain economist, and Rich Llewelyn, K-State extension assistant, kick off today's show as they take the time to explain common terminology that is used when discussing the market. Continuing the show is K-State grain economist Dan O'Brien as he provides his regular grain market update. Dan explains what the first trading day of 2025 looked like. K-State meteorologist Chip Redmond ends the show with a weather forecast. He says what cold weather we should be expecting and also reminds listeners to have their vehicle prepared for potential winter conditions. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Friday show talking about market terminology with K-State Extension Assistant Rich Llewelyn and K-State Grain Economist Dan O'Brien. Rich, Dan, thank you both so much for taking the time to join us today.
Thanks Shelby.
Wanting to talk through a few terms that we often use when we talk about the market, and the first one, talking about basis.
I'll start in. Basis is defined as the difference between the futures price for a commodity and its cash price at a specific location. And generally, when we're looking at the cash market basis, we're looking at the difference between the current cash price, say in Beloit, Kansas, versus if it's for corn, then the CME lead futures contract. And there are different terminologies for basis. In terms of a weakening basis is one that's getting wider. The local cash price is lower relative to futures. Strengthening basis, you'd have just the opposite, where the local cash price is getting closer to those futures. And you will run into situations where you have an even basis, or in some amongst farmers, amongst the grain industry, they'll call it par, basically where the cash price and the futures price are local cash price and futures price are equal. And a positive basis or over basis is again when the local price is higher than the futures, and we have that actually almost as a standard situation in the Garden City area for corn. Strong demand center in the state. And so we generally have a positive basis there or a lower basis. And we've just seen that. Well, you tend to see that in times when we have more than adequate local supplies and the price tends to go lower. I would add in, we keep track of grain basis on our AgManager website. Rich, you want to talk about that a minute?
Yeah, we have both a basis tool and some basis maps that we do weekly. It's the Wednesday close of the markets. And so then we collect that data for grain elevators around Kansas and around the region, actually, in surrounding states for the four major crops. So corn, grain, sorghum, soybeans, and wheat. And we post that. And what it shows is where prices are relatively stronger compared to the futures prices and where they're relatively weaker. And that can provide information for marketing. It may be that there is an elevator that's not that far away, but it's giving a better local cash price. And so paying attention to basis can be quite helpful, actually.
That tool does show basis history, where we've been in the past year, so we can have some picture or some idea of relatively stronger or weaker basis levels.
And we actually have on there, you can compare it the current basis to the average of the past 3 years or the past year or the past 5 years. And so you can kind of see how are we doing right now relative to historical trends.
And something else we wanted to talk about today, really maybe to just make people aware of these different terminologies and what they really could do to impact the market, import tariffs.
And I'll take that one. This is something that has been proposed by the new administration that's coming in, and it could have some effects on agriculture and on the overall economy, and it's in response to some of the things that other countries have been doing as well. Import tariffs basically they're a tax on goods or coming into the country, and so they raise the price of goods that are coming in. The purpose in many cases is to raise revenue for the government, but also to help with domestic industries and to protect them from competition from abroad. Now, in the case of agriculture, import tariffs on goods coming in, there's not a lot of agriculture products that will probably be taxed like that, but the effect for agriculture could be what other countries do in response to something like that. And so it would raise the price of our agricultural products in other countries, perhaps, if they respond and increase tariffs. In fact, a lot of agricultural products that we send abroad already are taxed in those countries, and it could make that even higher, making it more difficult for agricultural exports. What it does domestically is it raises the price of those goods in the country. And so for goods coming into the United States, if there are import tariffs, consumers here would pay more for them. And we would have the local industries being able to better compete, perhaps, but at a higher price and a higher cost to consumers.
And I would add into that, you look at a country like Argentina. Argentina has in order to raise governmental revenues, again, one of the main commodities that Argentina produces would be agricultural commodities, soybeans. So they have export taxes on soybeans, but not on soybean meal. So those taxes in the country kind of distort. I shouldn't say. Well, they impact. Some would say distort whether the raw beans are sold or the processed products are sold from beans. There are export subsidies that some countries have special incentives such as cash payments, tax exemptions, preferential exchange rates, etc., for different goods that company is trying to export. And in China, there was an export subsidy for used cooking oil that just came off. And this is, of course, U.S. soybeans oil producers, look at that as a government subsidy for a product that directly competes with them. So you've got these issues all at play. I guess something can be more subtle, Rich, or export licenses or phytosanitary regulations. I'm kind of throwing that in your lap. Do you want to talk about how that can impact trade?
Well, and some of those licenses are used regarding environmental issues or regarding food safety issues. GMOs in Europe have been subject to some of those things. So there's been a variety of policies that affect trade and then affect the producers and consumers of those commodities, both in the country receiving them as well as the country sending them out.
And phytosanitary regulations can be kind of subtle trade barriers. They say, well, I don't like the GMOs that you have over here, or I don't like the exposure to a certain disease over there. Well, it could be a subtle, quasi-sneaky way to limit import competition from another, to protect your own industry. So there are, I guess, when you get looking at trade, it's a hardball situation where a lot of countries are seeking to protect their own industries.
And something else that we always talk about when we talk about the grain market and the cattle market futures, and can you give us a breakdown of some different terminology that's commonly used?
So generally, futures prices are the value of a commodity at a point in time, determined through open negotiation and competition among buyers and sellers at a trade. Where we used to say on a trading floor in the exchanges, well, now we've transitioned largely to electronic trade for all that. So it's on a trading platform, which is a nice way to say it's computerized. But anyway, you have that, and for instance, it wouldn't be uncommon to see December 2025 corn at, say, $4.50 or $4.25 or $4, setting here in early January 2025, looking all the way out there. So that's an estimate of what supply-demand conditions will drive prices to. So that's a far distant price. And you have more current supply-demand factors represented in the upfront or lead contract price. So at this time, it'll be the March 25 corn contract that we're looking at. And we could have the same discussion with regard to the other commodities that we're looking at. And Rich, I'll just throw this out and let you comment on any of that you want. When you talk about futures, we talk about the opens, or the opening price for a trading session, their close, the last price for a trading session, settlement price, the midpoint of a closing price range. When you look at the internal, we see kind of a cleaned up version of what actually happens with all those trades, those thousands of trades that happen. They give us one price that they settle on, and it can be difficult to deduce what exactly that last price is. So, Rich, any other comments?
Well, just one on the limits of price moves in each day. There are limits on the futures markets as to how far a price can move in any one day. For corn, for example, I think it's 30 cents per bushel is the limit. And then if it hits that limit one day, then the following day, it's actually twice that, and it's allowed to move even more if there are major market moving factors going on. So that's something to be aware of as you're operating in the futures market. One of the things that people do pay quite a bit of attention to is the harvest contract for grains. So for that, for soybeans, that's generally considered to be the November soybean contract. And then for corn, the December contract is usually considered the harvest contract for corn. For wheat, it would be the July contract for hard red winter wheat.
But then for in reality, and for hard red spring wheat, again harvested later, it's basically the September contract.
Right. One other thing for Kansas here is that grain sorghum doesn't have a futures contract. And so corn is usually used as the proxy contract to kind of fill in for the grain sorghum. And so we a lot of times will calculate our basis. In fact, not lots of times, all the time, we'll calculate basis based on the corn futures contract and the sorghum cash price.
We economists would refer to that as a form of cross hedging, but it's pretty close cross hedging. It's not grain sorghum being a competitive feed grain with corn. In many aspects, again, trades off the same contract, as Richard said.
Dan, Rich, I appreciate you both taking the time to join us today.
Thank you.
Thank you.
That was K-State Extension Assistant Rich Llewelyn and K-State Grain Economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but when we come back, we'll once again be joined by Dan O'Brien for this week's Grain Market Update. You're tuned in to Agriculture Today, and we continue our show with K-State grain economist Dan O'Brien with a grain market update. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, what are we seeing for futures in the grain market?
Well, of course, yesterday was the first trading day of 2025. And I'm reminded, in looking back at 2024, especially in the corn market, that we had a year where literally the opening day prices for that marketing year were the highest prices that we had all year. Now, I don't know that will be the case here, but it's no small thing to look at what happens at the beginning of these marketing years, of these calendar years for the crops, particularly if you're looking at December 25 corn, November 25 soybeans, July 25 hard red winter wheat, and actually the December contract as well. So anyway, little small thing, and I would say, when we look back at last year for corn, we went down some, came back up in the summer, but that uncertainty coming into May never reached the high of where we were at right now. Of course, that was a higher price of $6 corn. Well, we closed yesterday at 459 and a half, at a half for the March contract for corn, and harvest at 446 and a half. And generally, with any planting uncertainty, unless we have unforeseen problems, we'd probably be higher than that. However, that's where we stand. So anyway, when you look at the closes yesterday, as I said, March closed at 459 and a half, Dees at 446 and a half, and corn of the three main commodities has been showing some strength of late. Underlying demand positivity, I guess, coming into play. And for soybean futures, we saw the January contract, which is now in delivery, which is a surprise. Here we turn the page and we're delivering on the January 2025 contract. So the lead, and that was $9.99 and a half, but the lead contract that the cash price is based off of now, the March 25 contract, $10.12. And actually, both corn and the soybean futures are up a penny or two, a penny and a half, thereabouts. And wheat was down, actually. The March contract closed 551 and 3/4. The harvest July 25 contract, 569.5. That was down about 6 or 7 cents, depending on which contract you're looking at. And really the carrying charges, as we look at those right now, if for a lot of folks that still have old crop corn in particular, and they're looking to what signals the futures are giving them for carrying the crop, well, we've got carries from the March to the May contract of about just under 4 cents a bushel, which is just kind of break even with on-farm storage. And if we're in commercial storage at 5-6 cents per bushel per month, it's below that. So that's not the best story for people storing, at least at this time. And the soybean contracts, you are seeing carries from the March to the May contract of about 6.25. From March to May, 6.5 cents. From May to July, 6 and about 3/8. So anyway, got a little bit of carry there, about a break-even deal as you go forward. And then carries for wheat, again, all the way from March to May to July, you're looking at about 4 cents a bushel a month. And then surprisingly, you get when you get from July going into September, you jump up to 6 cents a bushel, 6.25 cents a bushel carry. So I think it's, as you and I talked about before we came on the air, there's some more information in these markets that we can look at. At this point, with the bearishness in the market, it's sobering, and we'll be polite, say it's sobering to look at, but so you go back and look, when I go back and look at the December 25 corn futures and try to gauge, well, what's the market expecting? So again, yesterday, Dees corn closed at 446.5. When you look at a 450 put option, costs about 38.5 cents. So 450 minus 38 cents, you're at about 410 thereabouts for what it would cost you to actually buy a put option and protect yourself from any downside move on D's 25 corn as it closed yesterday. And also it's worthwhile to look at, well, when people have bought put options in the past, which strike price or which price level are they buying at? Strong, dominant quantity of 14,500 contracts of 5,000 bushel contracts are right on $4. Then a fair amount at 9,000 at 440, about 6,000 at 450, and 430 about 450 about 6,000, and at 430 about 6,600. So the market is sure, when people are going into that corn futures contract, into the options market, underlying the corn futures contract, buying their downside price insurance through put options, they're hanging around 440 or there's a bunch of them wanting to protect themselves from anything falling below $4. It just is as it is. And then for soybeans, you look at November soybeans, the same type of view, closed yesterday at 10.28, and you look at a $10.20 per bushel strike price. And again, as a level to buy a put option at, that costs you, well, about 61 cents a bushel. So from 10.20 minus 60 cents, you're down at 9.60, 9.50 thereabouts. And by the time you deal with brokers and such, and the most of the quantity of what's been bought in this range anyway for put options is right on $10. 6,172 contracts, 5,000 bushels apiece. So when these folks are going into that market, buying their downside coverage, they're buying it at $10. And that's, gosh, and what have we seen for soybeans in the last several weeks? We've seen them hanging right around $10 or a little bit below that, come back up above it. But that seems to be the narrative mindset of people. For wheat, you look at July 25 wheat. Now, take note that if you buy like a Dees option, for corn, you have to get out of that in about half, 2/3 the way through November. By a November soybean option, you have to get out of that in last part of October. If you buy a July wheat option, you have to get out of that in June. So that for us here in Kansas is a little more problematic because we may not have the crop out by then, but we'd have the price coverage at least up until that time. So when you look at the put options for July 25 wheat, and again, it closed yesterday at 569.5, you go right to 570 for the strike price where we buy the insurance at. That downside price coverage costs just about 47 cents. So let's say it's about 70 cents. So you're looking at somewhere between 520, 525 for where the market's kind of protecting itself at. And on yesterday's market, there's not near as much volume in the hard red contract. We're talking about hundreds of contracts rather than tens of thousands, such as in corn and 6, 7, 8 in soybeans. But most of the quantity of where the market's been buying that downside price coverage at is at 550 and 560. So I don't think any farmer, market watcher in Kansas on these commodities is surprised at these things. What I would add in, though, is that right now we have no real worries about weather risk coming in, and that's still just very beginning of the year. And that weather risk that can express itself in South America, some rumblings of some issues in Argentina, still opportunity for things to turn around, turn hot and dry in Brazil, but nothing has happened yet. So we start the year in a situation where we're not really worried yet about any weather issues and all the trade worries that probably most concerning probably to soybeans on the one hand and grain sorghum on the other, and possibly wheat. They're still something we'll deal with once we get past January 20th. The inauguration of the new administration coming in, and a lot of those things are positioning, framing, et cetera, until we actually get down to business and start negotiating. So anyway, I think when we're kind of looking into 2025, the markets right now are not, it's not that they're not concerned about what will eventually happen, but for weather issues in the U.S. or what could happen, but they're not on the front burner yet. So right now, kind of standing where we're at and aren't that terribly concerned about anything at this moment that would drive prices higher. So we're kind of hedging our bets on these rather conservative price levels for the new crop contracts that we just talked about.
What are you keeping an eye on for 2025?
Yeah, for this first day, I think I'm not near as willing to discount weather uncertainty and geopolitical disruptions as the market is right now. And geopolitical issues that come in, there are winners and losers, and some of the winners and losers have to do with transshipments moving around the globe just in different directions. Are we just shifting around the chairs on the deck, to borrow an expression from the old movies? Anyway, point being that I'm not near as willing to just lay down my thoughts and say that, gosh, I don't think there'll be any risk and uncertainty that could drive prices higher this year. I think we're at a very docile time at this moment. Seasonally, we get out to April, May, June in U.S. planting and then have to deal with actual realities of what's in the field. But at this time, we have the idea that, hey, we have more than adequate stocks, and we're not going to worry about anything until these are buyers markets. Again, if you don't buy a pile of grain today, they'll still be there next week. So with that, you take away the urgency and you end up with prices like we have right now.
Dan, I appreciate you taking the time to join us today and give us our grain market update.
Thank you so much. Appreciate it, Shelby.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but stick around because we have more for you up ahead. You're tuned in to Agriculture Today, and we conclude our Friday show with a weather update with K-State meteorologist Chip Redmond. Chip, thanks for joining us today.
Yeah, Happy New Year.
Chip, as we look about the weather we had over the holidays, really beautiful weather.
It really was. We had temperatures running anywhere between 10 to 15 degrees above normal for the period from Christmas to New Year's, and that's pretty significant when we look at the long-term trend of we should be cool this time of year and not in the 50-degree mark in the afternoons. But it was definitely very, very nice temperature-wise. Didn't have any big precipitation events to make travel challenging or anything, and it was really ideal. There was fog. We had several days of fog. I think it would end up being about Christmas Eve or the day before Christmas Eve to a day after Christmas. And that stretch of 3-4 days, we didn't see the sun, and I know a lot of people were starting to get a little stir crazy. They wanted their vitamin D, but it was overall kind of nice weather because we didn't have big temperature fluctuations, and we actually had some moisture in the air, whereas winter's typically a dry time. But all that moisture tends to lead to an incoming storm system, and all that moisture fuels the storm system, and so change is definitely about to occur after ending December in 2024 on a warm note.
And Chip, you mentioned it should be cool, and definitely something we're going to be seeing.
Finally, the transition is going to occur. We've been expecting this cooler weather for really over the last month. We've been talking about right around that New Year's Day time period. We're a little bit later after that. But, the polar vortex is going to dip southward, and we're going to get a lobe of it as those winds weaken. It's going to move south, and that's going to bring big temperature differences by the weekend and then into early next week, especially when the true cold air arrives. Temperature is going to be running about 10 degrees below normal. We'll see highs struggle to get into the 20s, and we'll see lows potentially below zero, especially on Monday and Tuesday morning. And we're going to add some snow on top of that. When we get this big transition and a big change in the weather, typically initiated by a strong storm system, and that's what's happening. That storm system is on the edge of that cold air, and we're going to have that moisture stream northward and then get undercut by a cold front. So we'll have cold air at the surface, and that's going to provide a wintry mess Saturday night and into Sunday morning for a lot of the state. Potential is there for maybe up to a tenth, maybe even 0.2 of an inch of ice accumulation. There is some uncertainty on just how much freezing rain it'll be, because we tend to get sleet that can, ruin the party, because we can't really forecast sleet very well. And sleet's just those small little pellets of snow and hail combination. And that can really cut into the freezing rain totals as well as cut into our snow totals too. So as that system moves off to the east, colder air funnels in and we start to change over to snow by Sunday morning. And it looks like right now pretty much most of the state will see some snow. The heaviest snow will be likely east of US 81 and along the I-70 corridor, and probably highest totals be around the Kansas City area. There is some potential for maybe 10-plus inches of snow, but with that freezing rain and sleet, it will cut into those totals where it does occur. Further west, maybe a dusting to an inch in portions like Garden City and northward to Goodland. The other concern I have is on the back end of the system. All that cold air is going to be funneling southward from Canada, and we're going to get strong winds on the backside of this system. So any snow that does fall is going to start blowing. We'll have a lot of blowing snow going into Sunday night and into Monday. And I know a lot of kids are looking to go back to school on next Monday. And I'm going to guess that's a challenge for a lot of folks with blowing snow and snow on the ground from our first real true winter storm system of the year.
So, Chip, as we have really cool weather and really cold weather, some concerns and some precautions people should be taking?
Yeah, be prepared travel-wise. Make sure you're prepared with food and the right things to help get you unstuck if you would get stuck in the snow with your vehicle. And then, winterize as much as possible. Good chance to put plastic over the windows. We're going to be in this cold spell for at least through next weekend. Then looking beyond, there's potential for more cold, a little bit more uncertainty. But just definitely take steps to be more prepared, longer times of travel and that kind of thing.
That was K-State meteorologist Chip Redmond. That's all we have for you this week on Agriculture Today, but we'll be back with more for you on Monday.